Boa tarde a todos. Inicio agradecendo a apresentação, agradecendo a presença aqui desse público muito honrado, público muito nobre, nessa ocasião muito especial. Queria, já de partida, fazer um agradecimento especial ao IBDT. É de fato um orgulho estar aqui, ter a oportunidade de ser presidente dessa mesa, ver e admirar o trabalho do IBDT, o que tem sido o trabalho do IBDT, a contribuição para o estudo do direito tributário no Brasil, o que significa, inclusive, no plano do direito internacional tributário. Creio que aqui seja uma enorme oportunidade para troca de ideias, para estudos, para debates aprofundados. Então, de fato, é uma grande honra estar aqui. Fica aqui, de início, o meu agradecimento em função dessa oportunidade de estar aqui com vocês. Bom, estamos muito perto do encerramento do Congresso e cabe a nós aqui nessa mesa tratar de mais um dos temas palpitantes, mais um dos temas que tem afeição e tem muito do que significa o nosso direito tributário brasileiro, dos problemas que vivenciamos, das questões que já enfrentamos há alguns anos, de questões de deficiência legislativa ou, sobretudo, talvez de falta de normatização e que desaguaram agora num tratamento legislativo, ainda que novo, ainda que incipiente, mas um tratamento legislativo que já se aguardava há décadas, relativo, sobretudo, a dois temas que guardam muita
subjects that have an affinity among them, which are the intragroup contracts and sharing expenses contracts. So we live in the plan regarding consultation solutions. Now we have not only the legal treatment, but also discipline and normative instruction. And in addition to this, we have a process of public consultation underway related to this subject. So we must have a drill down regarding the subject, transfer pricing, intergroup service, and cost-sharing agreements. When I was invited to be part of this table as chair, I would like to deliver some words on the subject, both subjects unfolding and complement each other, but I soon saw those who would be here with me, the peers at this table, and noticed it would be egotistical of my side to be part of this time. So I would like to open the space and all the time they deserve, because the debate will be the highest level possible. So I end now, and I pass the floor to Adriana Biri, to the moderator of the debates, and then we will move on with the agenda. So good afternoon. I'm very pleased to be here at this panel with professors, peers, friends, to talk about this important subject that we love, and some are passionate at with the subject here at this table, and share a lot of their practical experience that they have. We have 3 intense days in this Congress, several lectures, interesting panels, so our mission is quite impossible and difficult to hold your attention, but we promise we will comply with this mission. And I would like also to stress the opportunity and thank the invitation to be here on behalf of dear professors Luis Flávio Neta, Ricardo Maito, and Schwery. I'm very pleased to be part of this table. Before passing the floor to our lecturers of this module, I will place food for thought, because it has to do with many of you that experience this sort of structure during their daily affairs. Do you think the new rules of transfer pricing extinguished the portion of expenses as we knew in the past? Do you think we have some space for maintenance of the concept of expenses reimbursement, as we saw throughout the last years, after the last cost sharing agreement are equal, and what was said by the IRF and what it said. So to deal with it, I invite first Luciana Gallardo, so she can share with us a bit of the expense portion contracts and its history. So thank you very much. First, I have to say I'm honored to be back to Largo São Francisco, this noble room where I obtained my master's. So I'm very pleased to be here with very important people. Thank you for the invitation of IBDT. But before starting, I would like to honor 2. First, Professor Gert Hortman, who was my guidance guide during my master's, contributing to IBDT throughout this time. And had the opportunity, I had him doing the first words preface of my book. So to start and cheer up the end of this afternoon, Gerd was someone very special that generated lots of knowledge in this subject matter. And during my master's, he was there helping me. And second, and I would like to honor also to Elige. This is because I started tax law with 18 years. It does not seem, it seems yesterday, but I was 18 years old and I was a trainee at Price Waterhouse before starting at Pinheiro Neto, and she was my first teacher. Therefore, when I saw her delivering a lecture, I was 18 and I was a trainee at Price. I said, "What a fantastic woman! How didactic, knowledgeable." In a world that tax law, it was more towards men, and you were already heading at Price and leading at Price brilliantly. So it's an honor, satisfaction. Many years after sharing this panel with you, I admire you, and I hope I will always have your strength, smartness, and discipline. Well, let's talk a bit about cost sharing, which is my dear subject matter. I really enjoy it. Well, basically, it's the following. How sharing started with me. The office has a client, the Arthur Anderson, which one of the big auditing companies after some problems it faced in USA. And competing with Price and many others back then. Arthur Anderson was an international company and it was a client of our office and came to us because they had a training center like this one I did in Price in Brazil with Elige. They had a training center in Illinois, in St. Charles City. Back then, all the auditors everywhere went to St. Charles, USA for accounting classes. At a certain time, USA noticed that all that expenditure was being allocated just for the American company. And in a way, all the further companies worldwide benefited from that training center. So there should be a criteria where I could apportion expenses regarding rent, professors, light, and so forth amongst further companies worldwide. And this was done. And the office back then, I was part as an intern of the first contract for co-sharing costs and expenses international by Arthur Anderson and all companies worldwide known. Back then, there was an importance huge regarding INPI. They had a main role regarding international contracts. Always concerned if during that contract there was the existence of some technology and if by force of that contract there was a transfer of technology. So we took this contract for to be examined for this tax that there was no technology and therefore it was just pure services, no markup, where I wanted just to allocate and share those expenses amongst all companies of the group. Back then, INP had an important role because by confirming if there was technology or not, it would control the future sending of monies. In a way, if the parties were contributed to a new technology and all this development of technology, it's industrial property taxes. So it was being paying royalties for the technology because all companies contributed for a new technology. So there was a huge control role in this descending. And perhaps it was good because it was in a portion contract where we don't have transfer of technology. We would never talk about siege being levied the excise like to put when we have contract of this nature. On an overall, they have interesting characteristics we all know, but it's important to stress. Therefore, first, one of the big characteristics that I find important regarding new legislation is because there are contracts that are out of commerce. What is it? There's no intuition of intention, I'm sorry, of obtaining profits for that business. And the contract was excise tax. It's skill gain at having those with expertise, so you not the back office where you have human resources, financial, legal areas. What makes no sense that each company of a same economic group to contract different groups to render the same types of services. The intention was not being this service the end activity of the company, but no doubt this was the middle activity of the company. The intention was not to make profit with this activity, but the company as a whole who capture an advantage by standardizing and skill gains and be reimbursed and allocated to those companies that use more this back office type service. On an overall, all these contracts they have characteristics that are here enlisted, especially because we understand that contracts of this nature should never have any markup. This is because the intention is not sell services, is not my main activity. So following this slide, the apportion contracts they were out of the previous rules regarding transfer pricing because as the name sets forth, transfer pricing supposes a price, a selling something in fact, and therefore I'm not buying or selling, I'm not exporting or importing, I'm not rendering services of an activity. Therefore, I wouldn't have a why to submit to the previous rules regarding transfer pricing. It's worth explaining for the purpose of transfer pricing that you will know more than me all the methods and the objective methods formally worked with a fixed margin or profit margin embedded on those prices. And such fixed margins, naturally, they are far from the concept of markup that we don't enforce in contracts of this nature. Therefore, in the past, we say past, but I'm going to talk about the present because we have a debate here. If we understand that we are subject to the new rules for contract of this nature, but based on the previous legislation, it was clear that there were no way to enforce transfer pricing rules to contracts of this nature. This because there's no markup involved and neither price. They are not onerous contract out of commerce. Therefore, always used concepts of pass through. So debit invoice, pass through the previous contracts, and the excise in a way accepted most of the time the solutions for consultation that these contracts they were therefore neutral regarding tax point of view. Reimbursed value should not be dealt as revenues for those who receive, and therefore there was no way of saying taxation for those paying pays. Expenditures, on the other hand, should be deductible because I allocated the right expenditure for the company that truly benefited from that. It was talked a lot, the portion criteria. First, the direct criteria was highly used, and not all had easy to do time chart. We auditors and lawyers do, and they hated the chart of times and disclosed that one of the good criteria of a portion would be invoicing was one supposes that a company that invoices more demands more this type of service and it has been and is accepted by some is the exercise by some of these decisions. Solutions for consultation most of the time favorable. Perhaps there was one of the not favorable, but of course misled and even by fail of those who pose the question, and their sense always out of trade and therefore out of taxation. Also, we had decisions that administrative decision and legal decision that were favorable. And Elige will talk, and I recalled well in the past, banks and financial institutions did this within Brazil. So you had in the case the first jurisprudence of Itaú Bank, the broker of this bank, you had leasing administrator of this bank, and they did an apportion of expenditure among these companies, and this was accepted by jurisprudence, understanding that all these activities were secondary and they had as a purpose profit, and therefore they could be duly apportioned with no sort of taxation being levied. Also, we had decisions that were not favorable, unfavorable decisions, and the worst, it was my client Arcos Dourado. The case was judged by the Superior Chamber, and in fact, there was a mistake by CARF and the Superior Chamber by understanding that when I send this money abroad, I should always have withheld at the source. And they understood what I'm sending abroad is not revenues, which is the base of income tax that's levied on taxes. And as I'm repaying someone reimbursement, we are not talking about withheld withheld tax on the source. And we went to the discuss court, and there was a ruling regarding CG. We shouldn't talk about technology transfer, so shouldn't be CG applied on these contributions. So, with these opening remarks, what we conclude, it's good to conclude. I can't see what I'm projecting, but let's hope I'm saying the right thing. So I would like just to conclude is the following. Now we have a new legislation for transfer pricing. This was subject matter of analysis by this Congress that has a shift regarding the point of view related to calculus. We exit a objective system, easy to calculate. Perhaps it did not correspond to reality. It was this or that. Above the method, it was deductible. Below, it was revenue that should be taken into account. For legislation, but more legislated, more connected to OECD rules, the principle of this arm's length principle. I really don't know what's that, but we will have to ascertain for each case. These are methods, and this will be a fantastic work that a new cycle starts for all of us. Finding what is the arm's length transactions between related parties. So the shift in translation was regarding the ascertain of methodology. But our feeling, now going to the end of my presentation, when you talk about a portion of expenditures, again, you are out of the concept of prices. You are out of the concepts of selling and transferring something. We still are within the concept of not burden, not onerous, in a concept out of commerce. Legislation disciplines several transactions as being intra-group services, but the base legislation does not ingress in cost-sharing services. Those who entered low added value services was the normative rule. Regarding it, I believe that we still have space to fight, as the normative rule cannot demand that taxpayers will add a margin of profit when in fact this does not have the backup regarding the legislation. Of course, that the subject matter will be the object of more exam by the excise, and compared to the international rules, many of the foreign companies that are abroad, they submit themselves to the methods and add a markup, but according to its essence, still in Brazil, we would have space to advocate that contracts of this nature depend still from a right regulation. I don't have a law demanding markup, in fact. So our advice is to draw up a contract without markup, and if by any reason the taxpayer does not want to incur in risk of facing a supervision, fiscalization, it would add the up to 5% or 5% in the fiscal profit, always with the space in order to fight, as the normative rule in this aspect does not have backup regarding the legislation.
The OECD rule can be applied. Let's hear what the other panelists say. but there is still a possibility of continuing to apply this apportionment contract. And then we can also publish the third edition of the book if it cannot sell opinions. Thank you very much for your attention. Thank you, Luciana. Excellent inputs. Now, Professor Elidio, he'll make comments for all presentations. So she's going to make comments on the presentation, on the talk delivered by Professor Luciana. Good afternoon, everyone. I have two acknowledgments. First, for the invitation, I would like to thank Ricardo Maris on behalf of IBDT. And the second acknowledgement is to thank everyone and all the panelists. And I have to use 1 minute to thank what Luciana did. Well, actually, you just left me with empty hands. But anyway, my duty here is just to make comments on what everything has brought as an input. What Luciana brought as interesting was the quote on Arthur Anderson, because the apportionment of costs that we have seen in Brazil was eventually applied in national and international businesses. And this was regarded as something good until the day when the social contributions came into the scene for with the intervention of the main. And the origin of these contracts of apportionment derived from the management contracts that she mentioned, and also because they were groups of companies of limited company laws. So each until there was only one purpose for the companies until a certain period of time. They could only have intermediation of money, and then they claimed that what we have today being made by multiple banks. Because they could not do that, there was just entity that expanded, that made all the expenses, and this is what we have as a result of management contracts. And then this was just also replicated worldwide. The major issue with regard to these contracts is that there was no price established, and so this is why there was not a service sold, and was not even a product sold. It was very much used. I recall that when we have the transfer pricing rules published, we had to say to our customers or clients that this would not apply to them. But with intervention and social contributions, everyone started to think better, especially with regard to importing all this apportionment coming from other countries. So this is just to contextualize what Luciana said. She is an expert in this field, and her books is even mentioned in court decisions. And the apportionment that we have here is something that will go from certain impacts of interpretation in light of the new rules related to the price transferring rules. Because our Supreme Court has seen services in a bit different way. We usually have that ruled by the civil law, but if you see the guidelines, we can see the rent is something that under the criteria of transfer pricing, but down when we have the decision of the Supreme Court in Brazil, this is not really so. So this is why we have some deadlocks. But from now onwards, we are going to have many new things to think of. I'm speaking of the domestic ones. So domestically, we have many things to think of and to discuss. So this is just the first input for us to think of. Thank you, Sergio. So now I pass the floor to Professor Gustavo Vettori, who will bring his view or in-depth view with relation to the price transfer or transfer pricing um, perspective. Maybe my opinions are not very popular, but let's find out. First of all, I'd like to thank for IBDT's invitation and celebrate 50 years of the institution with this 10th Congress. It's really an achievement. Thank you, Luis Flavio, Marco, and Schroeder. And also like to greet my colleagues in the panel. My mission is to speak about the impact of the new the transfer pricing rules and cost sharing. I will speak in three parts. The first one, the topic has already been introduced, and what is the cost sharing framework, what it was for, if it's for onshore operations or cross border operations, if there's any difference, and what are the taxes involved. Then we go to the new transfer pricing rules and see how they relate to intragroup services and what we would call cost sharing in Brazil, whether it is still intragroup services or something else. And then I'm going to give you a glance on what we have in terms of what we call cost sharing. And then Jose Manuel will speak about the next two topics, so I'm not going to go deep in that. But then looking towards the future and the effects as a result of the new law, and also let's see another discussion about taxing at the source and cost sharing. In order to wrap up what was said, in the landscape we have what we call cost sharing agreement is precisely as Luciana described. It was built based on doctrines, consultations, and some decisions of the CARF, as showed by Luciana. It is important for us to see that in many of these cases, for queries, for example, is for onshore cases, so payment of internal expenses. Now, why do we discuss this domestically? Because there are many taxes charged, levied on the asset. Of course, we have to see whether this is just a credit or not, and because then we have the PIS and COFINS taxes levied on them. It is also important to see whether an expenditure can be deductible according to the companies that are sharing that, or whether this will be only on the headquarters or what. And then we have the cross-border discussion and some other queries that came to the IRS. And transfer pricing appears in just one of the queries. All the other ones related to taxation at the source, at the income tax, and seed and PIS/COFINS, and or a combination of all of them. This is so because we have taxation of the services import that is irrelevant. And on the other hand, we also have taxation at the source when we send income abroad. And this is a 25% rate plus seed, which is something particular to Brazil, which was exported to other countries too. So when we look at the history, what we see is that the concept was built over time, and then we lose focus on what is really at stake, if this is onshore, cross-border, or charge or levied on the source. And then we build an agreement of sharing as if it was something abstract. And it seems to be complicated, especially when we see onshore cases and the concept of typical guidance being imported to apply to that. Is this a long-run benefit? But why? What is this so? Because you're speaking about something different. This is onshore business. So the history that we see here has to be considered again. And then we have to see why we're discussing this, for what tax, because otherwise things will not be, or things will be very abstract. In 2012, this was an offshore case. This was really a transfer pricing situation. But then we have other queries that was really an offshore case, but these rules were applied. I'm not going to explain all of this, but I just want to say that if you deal with transfer pricing, this is TP, and all the other discussion is really the withhold at the source. So this is just something to make it clear. Now, what was the decision with regard to transfer pricing? Precisely what Luciana said. If we have a cost sharing, as was built, which was the core activity, and then we see that these are other services related to transfer price and so on, but then there is no adjustment. In most of the cases, it was importation, so this is not really relevant because obviously, provided I'm just paying whatever is cost, I could pay more plus margin, but this will not be a problem for Brazil. If Brazil is going to center or centralize all of this, then some adjustment would be more relevant. Then what happened to the new transfer pricing rule? Here we have the TP guidance, which is related to the intragroup service. Now, what is this? It is any activity rendered by one party, including the use or availability of a tangible or intangible asset or other resources that results in benefits to one or more parties. So, it can also be rendered of service by a central company. And then there is a definition of what benefit is, and Eligia will comment on this, so I'm not going to elaborate more on this. But what is a benefit? It's important to understand it. And I point out that this view is different from the regular rendering of service. And this is not the vision or the perspective adopted by the Supreme Court. But of course, it deals with transfer price and that income tax and CLL for certain cases, and the concept is totally independent. We're going to discuss what benefit is, but anyway, it is this. And then, what is not intragroup service, which are partners' activities, duplication of service, or incidental benefits that are created especially by synergy among the group. It is important to define it because if it's not a service, you do not pay tax and do not deduct either. So if someone is charging you something to perform an activity of a partner, so the controlling company is charging you because they are expanding with audit or to fulfill a law of the country where they are established. So this is something different. This is not intragroup service. You pay for something that is non-deductible. So payment is not acceptable in these cases. And here we have examples coming from the law of such a partner activity. Basically, these are situations in which your controlling company will have to do because they are the investors, for their own benefit, not to your benefit. And then here we have those intragroup services. And what does the TP rule say? There are adjustments that apply to that, and you were free the method to use unless there's a very low added value service, and then you have a fixed margin plus profit. But on the other hand, you are free to use cross plus or the method of net margin. But what is important according to the law is that you have some provisions saying that if you're going to use the cost method or a net margin method, they state how you can calculate all of this. And in the public consultation of the normative instruction, it makes you understand that every cost is considered here, regardless of the tax that apply to it. So I'm going to bring all of these above the line and then ignore the cost accounting. Well, if I use a net free margin, and then this is going to affect my database because this is a comparable that certainly was not used in the cost comparable accounting. I cannot compare two different things. I will have to make adjustments so that I can make them comparable. Okay, then I find the market margin considering those costs. But my concern is that when we speak about a low added value service, the margin is fixed. And then if you can put anything related to cost, of course, then especially in exportation, the price will be increased. So this is something that we have to understand very well and see to what extent the law applies. Now, what is the low added value service compared to the regular service? First, why do we have this distinction? Because this is just a simplified thing. So you're not saying that that is not a service. It is it the intergroup rule applies to it. But for you to make adjustments for ITP, no, the problem is too small. So just use a simplified method to have a work on a 5% margin, and that's it. Now, what are these cases? So these are services of support in a group or the core activity and not the end activity, and you don't have any valuable intangible and does not involve the assumption of any significant risk on the service that you render, and there is no maintenance of the amount for a relevant service. If you know our cost sharing principle, you see some similarities in these definitions of the core activity and so on. And then here we have some examples. So, for example, human resources, accounting, audit, and who else? Law or legal department. All of this is low added value service. And the IT, provided this is not really relevant, so it's not the IT that will build a new software. It's just for keeping the company running. And some other services that are considered administrative or office in nature. And then we have a definition what it's not: marketing, manufacturing, insurance, reinsurance. So this is just to give you an idea what the proposition covers. Now, in my view, until yesterday, what we considered to be a cost sharing service, this is just intragroup service, and this is a low added value service. And I understand that this is an idea created in the normative instruction, and so but the law establishes intragroup service and the low added value service is nothing different. It's just a method for you simplify that from something that has already been addressed in the law as a subject in the TP. Now, what does this mean for Brazilian entities? So if there is importation of services, so if the party abroad is only charging cost of reimbursement, and this has been allocated, and there is no margin because it is allowed in another country, so it's okay. You just deduct that. The law does not require me to deduct more than it. Now, if the multinational company, the controlling company or whoever is located in a country that requires this adjustment, then of course I have to deduct up to the cap. If it is a low added value service, then you have a plus 5% cost more, and then you have to think that because of the fact that this simplification method is in the normative instruction, you can use another method to calculate the low added value service, which is not that low in my group, and use another method to prove that the margin is bigger. So then here we have to discuss the amount that is used as a reference according to the law. So either you can close the door to this until you proven opposite or the contrary. On the other hand, if I have a company that is exporting services and is located in Brazil, then we have to charge, if it is low added value service, then you have a plus 5%. If it's other services, then you have to submit that to the TP methods. So I'm not going to speak more about the cost contribution arrangement because this is an asset that will give me return. I have to discuss how much I have to put in order to have a return. And the criteria has been very much criticized, and there are people saying that this should be eliminated because there is too much to the US. But actually, we have not faced anything like that here in Brazil. But I do not, this is something for Jose Manuel.
During the last 30 seconds I have, and to wrap up, there's a possibility of an effect of transfer pricing contaminate the other debates, especially levied fees, co-fees onshore, and the ARF source and other debates on onshore. If you look the first article of the law, the answer is no because it's tight in itself. The answer for the other combination should not arise from transfer pricing, but interpretation of the other taxes, according to my opinion. If I send money abroad, paying reimbursement of a mean service which my controlling company did, there's an income, but not according to transfer pricing law, but in fact to address and debate if it is or not taxable by the R source. Now, regarding of the legal outcome we might reach, and I wrap up here, taxing by 25%, this is crazy. Therefore, especially if we have a law, say, low added value service, the margin of non-resident, the gross margin non-resident is 5, looking figures, if it was charged 105, would it be a cost of 105 5 to gross? How much I'm withholding at source? This is 25.5 of tax withheld at the source. This is a loss. There's not a margin of 5, but a loss of 21. To have a 5 margin, it had to charge 140 the price, and probably I could deduct only 105 unless the siege is my expenditure, so I deduct in siege for withheld at source to a factor adjustment. I should have said this is service cost non-resident side. This is a more complicated argument. So reviewing this is more than time. Point of view of policy, we are doing very wrong in this type of regarding foreign service taxes withheld at source. So thank you very much. This is what I wanted to share with you. So I'm back with my 3 minutes. Well, I would like to share with you what would comment what Gustavo mentioned. But first about the law. The law is a truthful copy with a it's different from the topic of guidelines. This rule calls my attention due to terminology. I like accounting a lot. It seems to that IRFS terminology talking about economic context. Of course, these generate richness to be taxable. My concern is this norm with the on constitutional principles, especially the capacity to pay taxes. Of course, talking about the norm today compared with the constitution is too early. We have to see the infra legal norm that's being will be present, but my concern is about the economic concepts. When Gustavo talks about benefits, what's the benefit? Is it an economic benefit for both parties? Is it an advantage? Because accounting also talk about benefits. The parties must search for benefits. So I'm a bit concerned with this context of the law. But we will not be able to solve this. This is a red flag, and as we the cases are substantiated, we will see. In fact, when we talk the introduction of the international rules, I place my side on the side of international rules. I think we should follow the world. So this context is a concern in my opinion. Additionally, it's that both contracts we are talking about sharing costs and rendering services, they have nothing to do with our civil legislation, neither translation. The law sets forth that the content of these contracts is only applied to the transfer pricing rules, so we cannot mistake contracts that are dealt there with our tradition to the other areas of law. So it's one more red flag at the time when you interpret these contracts. They are complex, true, both cases, both services rendering as sharing, they talk about the benefits, which is, I said to Gustavo, this is my big question mark. Which benefits are we talking, economic or not? These are the comments I wanted to share with you regarding what Gustavo mentioned. Thank you very much for your attention. I would like to thank the presentation by Professor Gustavo and comments by Professor Elite. I think Professor Gustavo addresses relevant points, but some reflections that we need to face. Indirect taxes, once I call these services low added value services, how the indirect taxes stay It will be all the taxes in force today. And to share a bit about this view and reflection, I invite Professor Sergio André, who would present a summary of this panel and his view on cost sharing. Thank you. Good afternoon to all. It's always a joy to come back to this noble room. I say it's the highest point of my academic side when I'm invited to come here. So I'm very happy and thank Ricardo, Chueri, Zé Mario, Maito, Luis Flávio. I'm so happy to be here and congratulate my table with those so dear, and I will congratulate my peers from table in the person of Elide, the queen of tax law in Brazil. I can no longer congratulate my friend Joel Faria, minister, who is here with us. Gurgel is not only a huge tax lawyer, but it's the best persons I know in my life. So it's always a pleasure to congratulate Professor Gruzel and Minister of the Supreme Court of Justice. So time is short, lots to say. As Gustavo mentioned, to make my life easier, Adriana spent weeks asking what I was going to say. I didn't know what I was going to talk with it. Uh, Gustavo is going to talk about the remittance. So that's what I'm going to talk about. And I think first, and then I will base myself again in a talk by Gustavo. Not long ago, no, many years ago, in the same room, I had delivered a polemic talk about concepts. And I agree a lot with what Gustavo mentioned when we talk about cost sharing contracts. There is a sort of fixation in a definition of concept abstract ontological regarding cost sharing that does not exist, i.e., it's not relevant for us to keep on in this crusade of creating an abstract entity for cost sharing. Therefore, the tax system of a contract said cost sharing contract will arise from the concrete case. It will arise from the wording of the contract and facts. It cannot arise from the name, title. Therefore, the first thing one must think about, especially when we are addressing remittance taxation, is detached from the concept and disclose it, creating a cost sharing thing. It's a typical contract of civil law allowing Brazil. We are in the void of private law. Brazil's does not have a cost sharing typical contract. What we are have the parties agreeing and defining a legal relationship that depending on their content will reflect on taxes as we are thinking levied on what's paid abroad. So it's not because I called cost sharing. In fact, this is an issue that should be seen case by case based on concrete facts. We have a pathology regarding the debate of cost sharing, which is undue invasion of transfer pricing on it, especially regarding payments paid abroad. Definition of taxation of this being remitted. There's no connection with transfer pricing. They've never, since the beginning, if you recall, those who studied this more time recall that before 012, we had solutions of consultation sparse on the subject by the Inland Revenue, and the Inland Revenue said payments abroad for cost sharing was not deductible, unnecessary for the activity of company, was taxable as services. This was the official position of the Inland Revenue, and there was the number 1 November 12 consultation where it shifts its position, saying, in fact, to start with, it's deductible in that solution was specifically not exactly income tax, but there was a 19 income tax at source. When we studied the whole solution of consultation, it was clear that that concrete case was one of expenditures by third parties. So you had the made the headquarters abroad and contracting third parties, passing the cost for Brazilian companies and the inland revenue so that the cost went to the matrix, does not change the nature of services imported. It was the reasoning on that consultation. But the consultation on resolution number 8, it starts this huge mistake regarding the influence of guidelines transfer pricing regarding interpretation of domestic Brazilian legislation, no connection with transfer pricing guidance. And this was only became more clear as of 012. Inland Revenue decided several resolutions of consultation, and based on as of 017, there was the process of accession of Brazil. In 018, start the project of the transfer pricing reform bill. The influence of guidance of TP increases up to the point we reached to the consulta 076 of 019. Basically, the position of RF was mirrored of transfer pricing guidance. But we are talking about income tax withheld at the source for imports, which is something only in Brazil we have. It's siege and the tax is levied, and OECD transfer price in guidelines are irrelevant for this purpose. So one notice, as of 012 to date, what we notice when the RAS expresses itself, growing undue invasion of transfer pricing guidance, as if I interpreted my taxes with a view from Paris. But this is my, it's a concept, it's my first criticism. When you have a concept of cost sharing in the transfer pricing guidance, then you import that concept to Brazil and distort fully the understanding of our domestic legislation, and the mess we find today is established. When we get those cases that Luciana mentioned of Carrefour and Arcos Dourados, those who had the opportunity of reading decisions of the Golden Arts case will find a grounding absolutely different. We are not talking about transfer pricing guidance, agree or not regarding decisions by the CARF, and I don't agree, but decisions by CARF, they are more coherent and right because they are based on domestic legislation interpretation. They are not concerned in adapting the domestic to the international, which has no connection, and they have nothing to do one with the other. So we must understand when we reach this point, and then I get closer to the issue related, what Gustavo mentioned, in fact, and we have the law 14,490C, or new Act for Transfer Pricing. In fact, when we look TP law, two concepts are there. One regarding intragroup services, equivalent to what we always called as cost sharing, and as such, according to TP, is intragroup services. What we always called cost contribution is in a TP law as cost sharing. So we have here a distortion. The issue is the new TP law, is it relevant for the purpose of defining taxation on remittance? My question is very, my answer is consistent. No, it has nothing to do one with the other. When we get Article 23, first paragraph T, transfer pricing with the concept of services and service, if we look civil law, where's the concept of services? No, civil code never defined services. The definition of services civil law is the consumer's defense code, and it's a broad definition, more wide than the tax doctrine. We have this doctrine that quotes civil law, but they don't want to resort to. It has to prevail the civil law decision. If it's mine, that sort of imperial this, but civil law, the definition for services, Article C of the Defense Consumers Defense Code. Now we have a text definition of services of Article 1st, paragraph 1st, explicitly is for the purpose of this law. I don't have how and should never construe the income tax withheld of source and fiscal fees imports siege law based on services definition by transfer price. That definition is only affected on the subsystems TP. Therefore, I have sustained this and I'm very convinced it's new, not changing our debate. It might change facts, as said. It's a fact issue. Changing fact, yes, meeting what Gustavo said. The group changes the policy we are engaged and places in the contract. You change the policy for standard, adding a markup to the contract. It's not the definition in the law, it's fact being changed, caused by an adaptation on your changing the fact. Important thing I call the attention. And then following this line, I advocate. There's a certain slowness when we talk about remittance, as the reasoning of tax withheld at sort would be applied to all taxes. This is not true. IR source because basically through sharing non-taxable contract, it's non-taxable that payment is expenses reimbursement, which is a recomposition of assets. It's not called sharing, but it's taxable because it's assets reim. If in that concrete scenario I identify the specific reimbursement is recomposition of assets because the payment by account and order. Yes, cost sharing non-taxable. It's non-taxable because it's reimbursement that in face of the fact you're recomposing your asset. But it's relevant for income tax, but not that much PIS, fees, imports, and siege. Siege, PIS, fees, and imports don't follow the same logic of adding, increasing assets, and so forth. These taxes are levied on services. Our debate for these taxes, this can be characterized as service. I call the intention that this debate here and now opens a new window for a debate on services concept. We spend so many time talking about this concept of obligation to do and do to other taxes. This obligation of concept of service is different. As Luciana said, an activity carried out within a non-business context with no profit purpose can be taxed. If this is what I have to define an activity amongst related parties or not. I always advocated in cost sharing amongst independent parties. I don't think it's essential to non-taxable cost sharing for related parties. But if I have a situation where I have an activity developed out of business context, no profit purpose, can this be a service or it's not a service? It's a different debate on service concept. Again, believing on the concept debate. I have 2 minutes, and there's an aspect I have to mention. And then I wrap up here, and the last point is uh, Clara addressed the subject, and others also. All debates regarding taxation on services imported and tax withheld at source. This debate starts the second part of the 90s and created by Professor Xavier. Thesis was drawn by him. I bought all editions from his book, the first in 77 to see when the thesis appeared in 97, 98, fifth edition of the book. Before we didn't have it. And it was it started with a simplified debate. Either you have tech transfers and its technical service equal to royalties, or it's out of technical service. This debate, as we know, is facing resistance by the legal system, and both groups of Supreme Court have different opinions.
There is another discussion, which is sub-discussion involving our topic today, because when we think about cross-sharing, what is the payment of a typical one in back office, for example? It is a administrative supportive service. It is not a technical service ever. So, payment made abroad for a contract of sharing, regardless of all the discussions that we have done. So, if this is to a beneficiary resident in a country that signed the agreement with Brazil, so this should go to Article 7, regardless of any other discussion whether there's transfer or not. The problem is not a transfer. It is not technical service. That's the point. And if it's not a technical service, it is acknowledged by the IRS in Brazil that has more than one solution to this, especially to consider that that is an administrative service. Well, my time is up. I've been exceeding that for 15 seconds. I hope that I have not spoken so much nonsense, and I'll be very happy to talk to you during the Q&A.
Sérgio concorda.
I agree with you, Sergio. When Gustavo said, well, when he mentioned income tax return, I think that this is not related to transfer pricing subject. Uh, Income tax without the source is something of tax policy, and this has been 25% for a long time. When we speak about importation of services, there are other taxes that apply to that, and may reach 50% of the utility. So I fully agree with you, Sergio. These are two different things. I don't think that the transfer pricing rule should apply to that. Most importantly, I think that we have to focus on the major effects of these rules, especially on contracts of services and also of cost sharing, and the effects of these contracts. But for each one of the taxes, let's see how they will work. These are totally different things. Thank you for your attention, and now let's hear Rosen, right? That's it. Thank you. Thank you for all the inputs, Professor André, Sergio, and now Professor Jose Manuel, the guest speaker coming from Colombia. He's going to share with us now his international experience, and he will explain how the OECD guidelines have influenced all the Latin American countries in terms of cost sharing.
Hello to everyone. This is a pleasure to be here with you. I would like to thank to Professor Schueri, Luis Flavio, all the organizers. It is always a pleasure to come to Sao Paulo and see this dynamic community, this alumni that you have is incredible. And I think that that's a job of all of you that are very committed with this development of international tax law. So I will talk about the international perspective. So I would like to start highlighting that transfer pricing is for multinational managerial topic, but also requires a tax analysis, and CCAs are especially in the middle because they are ways for getting efficiencies from a managerial perspective, but they must be in accordance with the arm's length. So cost-sharing arrangements and cost contributions arrangements are pretty much similar whenever they are dealing with the same question, and is in the scope of the arm's length with agreements where the participants share the cost and risk of an activity and share the rights to the results, how to complete or to be fully respecting the arm's length principle. And those regulations in the US are nowadays under a strong debate of convenience because there is a lot of critics in the doctrine which is saying that they are allowing the transfer of intangibles abroad without any compensation, and at the end they are having problems also because it seems to be an exception of commensurate with income. Cost contributions agreements under the OECD were recently modified, and the OECD and the UN manual are pretty much similar, but the latest guidelines includes this analysis of measuring the actual contribution under the market value, and that was a change from the guidelines that were released in 1997. So there is a back to the future because it was the first approach that the OECD had. They are criticized because of the vagueness and absence of clear guidelines for hard cases. And in Latin America, when we see the questionnaires that the CIA has sent to tax administration, the answer by tax administrations use expressions that base erosion sources are contributions made by a local entity to a global chain of intangibles, intangible services, research and development costs, and their consequent remuneration. So it is a hard issue for tax administration in Latin America. And well, the application in the countries that I analyze, which are those Colombia, Peru, Chile, Mexico, and Argentina, are pretty much the same, the common conclusions. All the countries applies the transfer pricing guidelines. There are even a copy-paste in the domestic legislation or remittance to the OECD transfer pricing guidelines. That applies for the definition, the conditions, the documentation requirements, and in Colombia, for example, in our regulations, it is copy-paste the OECD transfer pricing guidelines. So it is required to comply with the arm's length analysis, which requires a reasonable expectation of benefits, a calculated contribution of each participant, a proportionality of contributions to the CCA and expected benefits, and we could theoretically conclude that in the analyzed countries, there is no risk for inconsistencies in the evaluation of contributions as much as we are copy-pasting the transfer pricing guidelines. So nowadays, we will have arm's length-based valuation of contributions. The information duties are pretty much similar to those included in the transfer pricing guidelines. It is required in most countries to reveal the existence of CCAs in the master and local files, but also in the transfer pricing return. The information that must be revealed is the one that you consider, the list of participants, the list of any other associated enterprise, among others. The OECD recommends to record changes of the agreement, the comparison of projections and the realized benefits, record the annual expenditure of the participants in form of cash, and valuation list of any associated enterprises. In Latin America, what is particular is that the reporters in the IFD reports says and recommends that it is important to keep evidence of the transaction, and even in the Mexican legislation, the domestic regulation, it is required to have all the documentation proving that the expense was passed on them and was actually incurred by the foreign entity. That I want to highlight it because in Colombia, we are going to see at the end of this presentation a case where it is particularly important. And well, what is the tax treatment of contributions and payments made under a CCA? I think that's the main question, and all the problems that you have mentioned before are related with that. And the OECD guidelines says that it must be determined by the domestic law and the tax treaties. So the transfer pricing guidelines does not solve the problem. Buy-ins and buyout payments clearly are in some way treated in the transfer pricing guidelines, saying that they must be treated as payments that were made outside of a CCA and as a consideration for the acquisition or the disposal of the interest in the results of the CCA's prior activity. So it is interesting. So we have at the end in a CCA contributions, balancing payments, buyout payments, buy-in payments, and all those payments can have different treatments, and that treatment requires an analysis from an accountability perspective, but also from tax law. And it will be considered a contribution, eventually recorded as an asset of the contributor, and a liability or equity to the manager, and not considered taxable for income for the PE, which could be commonly applicable in development CCA, and other commonly services CCAs are other qualification of those payments or even contributions that can be qualified as cost or expense for the PE, and income for the manager, cost or expense for the buyer, and not income for the manager when there is a mere reimbursement. Eventually, cost can be capitalized and then amortized. So it will depend probably on the accountability of that payments and contributions, and also the tax perspective. So the challenges in this way for the Latin American countries are the deductibility of those remittance, which sometimes can be considered income, even if there is a service that is not under the arm's length, or if there is considered a payment for a paying payment or paid out payment. The necessity requirement is commonly mentioned by the reporters. Also, restrictions for payments to non-residents are important. Those rules are applicable in Colombia. In Mexico, there is a rule about that, but that rule was considered not applicable when we are dealing with transfer pricing guidelines, because that those rules on transfer pricing were posterior to the first rules that restricted the payments. There are also registration of technology import contracts that applies in Colombia. There are also restrictions related with withholding tax as a deduction requirement. It is common in Colombia, and especially there is a rule that says that payments to home office in consideration for manager are subject to withholding tax regardless of whether they are deemed to generate Colombian source or not. They must have a withholding tax, or otherwise they will not be considered deductible. There are also challenges, because whenever there are a withholding tax that is applicable in the source country, there will be problems that can alter the proportionality under the arm's length principle. What about VAT? It would be also an issue in Latin America because there is a definition of services that includes any activity, labor, work. It will be similar, or pretty much similar, the problem that you have here. We have the destination principle, which can also have effects in a CCA whenever there is a participant in Colombia, but always it requires the existence of a service. And there is a special rule for collaboration contracts, which says that there is a transparency for joint ventures, but commercial relations that have a guaranteed return must be treated for all purposes as relation between independent parties. So there must be problems with CCA when there is with CCA, there can be problems with VAT whenever there are whenever there are a remuneration that is clear from the beginning of the contract. Case law, there is one case, it is the Consejo de Estado, the Supreme Court in Colombia. There were several issues. I choose two. The first one is the expense reimbursement and withholding requirement. The court in this case said that the taxpayer didn't prove that there was an expense reimbursement through invoices issued by third parties. So at the end, the expenses were not proved. So the tax court understood that there was a service that was provided directly by the related company. The taxpayer recorded some of the expenses as a consulting services, so it is important to see how the entities record the transactions under a CCA, because in this case, there was a mistake and there was a record as an expense for consultancies, not a reimbursement, and it was taken into consideration by the Supreme Court in order to say that there was a rendering of services, no a reimbursement. So since there were no reimbursement, they were taxable income subject to withholding tax, and in the absence of that taxation, the expense is not deductible. The second issue I want to highlight is the one that is related with cost contribution arrangement directly. In this case, Diane alleged that the taxpayer deducted 45% of the intragroup cost under the CCA when the allocation key stipulated a 34%. And the difference can be found in the application of a markup, because the CCA included specifically a markup, and the tax administration disregarded and added only the cost assumed. And the calculation were also different because in the tax administration perspective, they subtracted expenses from the assumed directly by one of the participants, and then added an amount invoiced direct by Bavaria. So in this case, at the end, the legal issue was if there were a connection between the payment that was made, or whether the total amount of the cost incurred by the service provider, by SAP Miller, America, and the other participant corresponds to the indicated by the AN, or whether it was what was indicated by Bavaria. So it was a matter of facts, and at the end, the rule was the same that is included in the OECD transfer pricing guidelines, and the Supreme Court evaluated the proofs, the evidence, and at the end, there were a clear explanation by the taxpayer about the reasons for having taken into consideration the amount or the total amount of cost under the CCI agreement. So the tax administration lost this case. So thank you very much.
Por fim, depois.
Well, after Jose, we have an initial flag when he says that every South American countries adopted the guidelines. And his experience is interesting because he brings some discrepancies that occur among the internal legislation and the guidelines. Not always the guidelines should prevail. So these are some of the issues that should also appear to us in Brazil. We had some previous situations, for example, the SINCAP, in which before applying the subcapitalization criteria, we applied the criteria of deductibility and other things. But here, it seems to be that the case is different because the TP guidelines apply, or only the TP guidelines apply to this. What we have seen based on the bookkeeping that seems to be something simple and improper can lead to taxation by the IRS. So this is why I think that what Jose brought to us is something interesting from other countries, because now we are incorporating all these issues when once we adopt the OECD guidelines. Thank you.
Thank you, Professor Lydia. And I thank the participation on all. I hope you have enjoyed this panel. Like I learned a lot. We leave these premises with more doubts than answers, for sure. But it means it was very good. But the only certainty I leave here today with is that multinational will have to review the structure and collection types and controls, regardless of what we call this cost sharing or low added value service. We must guarantee the cost is fit for use. Revenue, inland revenue will challenge taxpayers to review their cost in order to open the information with more detail, their information. So I think we have here a sturdy dispute and a challenge huge to certify that collections are the cost with a 5% margin. So I pass the floor to Paulo so we can close this module. Thank you, Adriana. I thank all the attention and especially all the lecturers that were here with us, Gustavo, Luciana, José Manuel, Adriana, Professor Lydia, and Professor Sérgio André. I believe we have something, a conclusion that we are at the beginning of a journey. Subject we have dealt with many years and change amendments in the laws. We are seeing far from solving doubts and providing answers, and the legislation to show itself highly controversial. We, IBDT to simulate reflections, debates on the subject and contribute in order that we can have major conclusions in the future years and a landscape more clear, allowing us to have guidelines more safe and certain. And following what Adriana mentioned, by the time being disputes that are already having and trying to avoid them now due to time. I think this is a special moment during this huge Congress, the Magna Conference. As the chairman, I know we have met the chronogram and passed the floor to IBDT to move forward with the outcome of this Congress following with the agenda.